If you are an investor in the Singapore market, you probably saw the headline yesterday and felt that sinking feeling in your gut. The Straits Times Index, or STI, didn't just slide, it shed 33 points, dropping 0.73% to close at 4,510. Then you look at your watch list and see Singtel, a portfolio staple, making news for all the wrong reasons, a service outage affecting thousands of users. And if you're looking at the smaller caps, you see LHN dropping 1.4% on what looked like a profit warning. It feels like the bears are back in town, and the instinct is to panic, to think that the rally is over, and to start hitting the sell button before things get worse. But if you strip away the one-off headlines and the global noise, the real story is drastically different. That 0.2% drop in Singtel, it's a blip compared to the double-digit profit growth underlying the business. That profit drop for LHN, it's an accounting mirage, masking the fact that their actual business of collecting rent is making more money than ever. What looks like a market retreat is actually a divergence between sentiment and fundamentals. The headlines are screaming risk, but the balance sheets are whispering opportunity. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise, ignore the clickbait, and show you what really matters for your CPF, SRS, and SGX portfolios. And we've been putting in the work. Since October 2025, this channel has produced over 1,200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context so you can uncover hidden gems and potential pitfalls. Today, we are going to do exactly that with a deep dive, point-by-point analysis through the latest market movements regarding Singtel, LHN, and the global AI narrative. First, let's set the stage with the macro view. The Straits Times Index closing down 0.73% is significant, but we need to define why this happened. This wasn't a local structural failure. This is what we call sentiment contagion. The nervousness didn't start at Raffles Place, it started on Wall Street. When the US market sneezes, especially the high-flying tech sector, global markets often catch a cold. We are seeing a pullback in the S&P 500, driven by anxiety that the AI hype cycle has outpaced reality. This fear trickles down. Investors see red in New York and instinctively sell in Singapore. But as analytical investors, we have to ask, does a sell-off in NVIDIA fundamentally change the ability of a Singaporean bank to issue a dividend? Does it stop a Singaporean landlord from collecting rent? No. The market vibe was cautious, yes, but it was an imported caution, not a domestic disaster. Now let's move to the first specific case study. Singtel. If you check the news, the story was service outage. A mobile service disruption affected over 1,000 users. Social media was loud, people were angry, and the stock price reacted by dropping 0.2% to close at 487. Let's define the risk here. There are two types of risk in investing: operational risk and fundamental risk. An outage is an operational risk. It is a technical glitch. It is embarrassing and it requires fixing, but it is temporary. It does not break the business model. Now let's analyze the fundamental risk. This is where the real story lies. While the market was fussing over a 0.2% drop, let's look at the data we discussed just recently. Singtel just posted a 14% profit growth for the first half of the year. That is a massive number for a mature telco. They have juiced up their dividend payouts, putting actual cash into shareholders' pockets. And perhaps most importantly, they are actively buying back their own shares. When a company buys back shares, they are reducing the supply, which generally supports the price and increases earnings per share for you, the remaining shareholders. From Iggy's perspective, this reaction is exactly what we look for. We call this a non-event for the long-term thesis. A 0.2% drop on a bad news day is actually incredibly resilient. It shows that the floor price is strong. If you are a long-term investor, you have to separate the copy talk headlines from the balance sheet. If you believed in Singtel's strategy of capital recycling and regional growth last week, a technical glitch yesterday should not change your mind. In fact, stability in the face of bad press is a hallmark of a defensive blue chip stock. Next, let's look at a more complex situation that offers a massive learning opportunity. LHN and Collywood. The headline here was confusing for many. LHN shares fell 1.4%. Why? Because they released a profit guidance stating that net profit before tax is expected to be lower for FY 2025 compared to last year. On the surface, lower profit equals sell, right? Wrong. Let's break this down methodically. We need to define two different metrics, net profit and core profit. Net profit is the bottom line number. In the real estate business, this number often includes non-cash items. The biggest one is fair value change. This is an accounting adjustment. If the estimated value of the buildings they own goes down slightly on paper, perhaps due to interest rate assumptions or market comparables, they have to record a loss on their income statement. But did they actually lose cash? No. It's a paper adjustment. Core profit, on the other hand, measures the actual performance of the business operations. It measures the cash coming in from tenants versus the cash going out for expenses. Now let's analyze LHN's announcement. They explicitly stated that while net profit is down, core profit is expected to be better than last year. This is the golden nugget. It means their main business, renting out co-living spaces through Collywood and managing properties, is performing stronger than ever. They are generating more cash from operations. Here is Iggy's perspective on this. The market punished LHN for the headline number, the lower net profit. But savvy investors look at the core profit. If the engine of the car is running faster and more efficiently than ever, do we care if the paint job is valued slightly less this year than last year? Not really. The fact that Collywood held flat despite the parent company dropping suggests that the market understands the value of the co-living model, even if it's jittery about LHN's headline numbers. This divergence between headline profit and core profitability is often where mispricing happens and where we can find value. Finally, let's tackle the elephant in the room, the Wall Street AI jitters. The S&P 500 is facing its longest losing streak in months, dragged down by giants like Nvidia. The narrative is shifting from AI will change the world to AI stocks are too expensive. Let's define the mechanism here. This is a valuation compression. When stocks are priced for perfection, any doubt causes the price to snap back to reality. How do we analyze this for Singapore? Singapore is not a tech-heavy market. We are a market of banks, real estate, and industrials. When capital flows out of high-growth, high-risk US tech, it has to go somewhere. Eventually, money looks for safety, yield, and reasonable valuations. From Iggy's perspective, this global reality check is a good thing. It reminds us not to get caught up in a single theme. It validates the Singaporean strategy of boring steady dividends. While the US market hyperventilates about whether AI will generate trillions next year, our local banks and REITs are quietly generating cash flow right now. We are watching a rotation from growth at any price to value at a reasonable price, and that suits the SGX perfectly. So let's bring this all together into Iggy's assessment. What is working? The fundamentals of our key companies are intact. Singtel is delivering double-digit growth and shareholder returns despite the noise. LHN is growing its core cash-generating business, despite accounting headwinds. The underlying economy of the companies we watch is functioning well. What is not working? Sentiment. The global mood is sour. The fear from Wall Street is overriding local logic. Investors are reacting to headlines rather than financial statements. This creates volatility that can be scary if you are watching the charts every minute. Regarding valuation, we are seeing valuations become even more attractive. When a stock like Singtel dips on non-fundamental news, its yield effectively tightens or becomes more attractive relative to price. When LHN drops despite higher core profits, its price to core earnings ratio improves. We are looking at a market that is pricing in a lot of fear, which usually means the downside risk is being capped while the upside potential remains. Here is my final recommendation. For existing unit holders and shareholders of these blue chips, hold. Do not let a 0.73% market drop or a scary headline shake you out of quality positions. The dividends are safe, the core businesses are growing, and the bad news we discussed today is superficial. You are paid to wait. Sit on your hands and let the compounding do the work. For new buyers, this is where you pay attention. We preach being greedy when others are fearful. If you have been waiting for an entry point into Singtel, or if you've been eyeing the co-living growth story of LHN, these pullbacks are your invitation. The market is offering you a discount because it is confused. It is confusing an outage with a business failure, and it is confusing accounting adjustments with cash flow. That confusion is your margin of safety. I would be looking to accumulate quality names that have been unfairly dragged down by this global tide. If you found this valuable and want to navigate these choppy markets with more confidence, consider becoming a free or paid subscriber to the Substack newsletter. We go even deeper into the numbers there, providing the charts and data that back up every single claim we make. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Your support allows us to stay independent and keep cutting through the noise for the Singaporean investor. Thanks for watching, keep your emotions in check, and I'll see you in the next analysis.